Hello everyone. Today we are going to cover IFRS 1, that is first time adoption of international financial reporting standards. My friends, before we dive into the details of IFRS 1, let me ask you a question. Have you ever moved from one house to another? When you move, you don't just pick up your things and dump them anywhere in the new house, right? You have to organize everything, decide what goes where, maybe throw away some old stuff, and make sure your new place looks proper and organized. Well, that's exactly what happened when a company moves from its local accounting standard to IFRS. The company cannot just randomly start using IFRS. There has to be a proper process, a proper starting point, and proper rules to follow. And that is where IFRS 1 comes into play. Now, IFRS 1 is like the instruction manual for companies that are adopting IFRS for the very first time. It tells them, okay, you want to use IFRS now? Here is how you do it properly. My friends, think about this. Around the world, different countries have different accounting standards. For example, Pakistan has its own standards, UK has its own, US has its US GAAP, and so on. Now, what if a US company that has been using US GAAP for years suddenly decides to adopt IFRS? Maybe the company wants to attract foreign investors, or maybe it wants to list on an international stock exchange, or maybe its parent company uses IFRS and wants all subsidiaries to use the same standards. Whatever the reason is, the company now needs to switch to IFRS, that is International Financial Reporting Standards. But here is the challenge. How do you make this switch? Do you just start using IFRS from today and forget everything you did before? Obviously not. Because then your financial statement won't be comparable. Investors won't be able to see the trend. They won't be able to compare this year with the last year properly. So IFRS 1 was issued by the ISB to ensure that when a company adopts IFRS for the first time, its financial statements are high quality and transparent for users. They are comparable over all periods presented and provide a suitable starting point for accounting under the IFRS. Also, they can be generated at a cost that does not exceed the benefits to the users. So, IFRS 1 is all about making sure the transition to IFRS is smooth, transparent, and useful for the investors and the stakeholders. Now, before we go further, we need to understand some important terms. These terms will be used throughout our discussion, so let's them get clear from the start. The first important term here is first IFRS financial statements. My friends, what are the first IFRS financial statements? They are the first annual financial statements in which an entity adopts IFRS by making an explicit and unreserved statement of compliance with the IFRS. Let me break this down for you. When you prepare your financial statements, you usually have a note right at the beginning that says something like this. These financial statements have been prepared in accordance with IFRS, right? Now, if this is the very first time your company is making that statement, then these are your first IFRS financial statement. Simple. My friends, the second term is date of transition. Listen to me carefully because this is very important. The date of transaction is the beginning of the earliest period for which an entity presents full comparative information under IFRS in its first IFRS financial statements. I know this sounds a bit technical, so let me give you a practical example to make it crystal clear. Let's say we have a company called ABC Limited. ABC Limited has a year end of 31st December. For many years, ABC has been preparing its financial statements using local accounting standards. And now, in 2025, ABC decides to adopt IFRS. So, ABC wants to prepare its first IFRS financial statements for the year ended 31st December 2025. My friends, you already know very well that whenever you prepare financial statement, you don't just show 1 year, right? You also show comparative figures for the previous year. So in the financial statements for the year ended 31st December 2025, ABC Limited will also present comparative information for the year ended 31st December 2024. Now the question is, what is the date of transition in this example? The date of transition in this case is 1st January 2024, which is the beginning of the earliest comparative period. Why? Because ABC is presenting full comparative information for the year 2024. So the transition date is the first day of that comparative period. Must remember, the date of transition is the start of the comparative period, not the start of the current year. Alright. The third important term is opening IFRS statement of financial position. The opening IFRS statement of financial position is the balance sheet, is the statement of financial position prepared at the date of transition to IFRS. In our example, ABC Limited's opening IFRS statement of financial position would be as at 1st January 2024. This opening statement of financial position is like the starting point for your IFRS journey. It is where everything begins. From this point onwards, you will be applying IFRS to all your transactions. Now, one important thing to note. This opening IFRS statement of financial position does not need to be published separately, but you need to prepare it because it will provide the opening balance for your comparative period. So remember, the opening IFRS statement of financial position is your starting point, prepared at the date of transition. Okay, now let's talk about the general principles that you need to follow when you are preparing this opening IFRS statement of financial position. My friends, IFRS 1 basically says, look, you need to apply IFRS retrospectively. So what does retrospectively mean? It means you go back in time and apply IFRS as if you had been using it all along. You look at your assets, liabilities and equity as at the date of transition and adjust them to comply with IFRS. Here are the key principles. First, the accounting policies you use must comply with IFRS that are in effect at the end of the first IFRS reporting period, and you must use the same policies throughout all the periods presented. For example, if ABC Limited is preparing its first IFRS financial statement for the year ended 31st December 2025, it must use the IFRS standards that are in effect on 31st December 2025. And these same policies should be applied for the comparative period as well. You don't apply different version of IFRS for different period. Consistency is the key. Then the second key principle is about recognition of assets and liabilities. My friends, when you prepare your opening IFRS statement of financial position, you must recognize all assets and liabilities that IFRS requires you to recognize, even if your previous accounting standards did not require recognition. And you must recognize all assets and liabilities that IFRS does not permit you to recognize, even if your previous accounting standard allowed them. Let me give you some example to make this clearer. Let's say under your previous local GAAP, maybe you are allowed to capitalize research cost. But under IFRS, specifically under IS 38 intangible assets, research cost cannot be capitalized. They must be expensed immediately. So when you prepare your opening IFRS statement of financial position, if you have any research costs sitting in your asset, you have to remove them. You de-recognize them. Similarly, maybe under your previous GAAP, you capitalize staff training cost or relocation cost, but IFRS does not allow this. So these have to go. On the flip side, maybe under your previous GAAP, you did not recognize certain assets or liabilities, but IFRS requires you to recognize them. For example, under IFRS, you need to recognize deferred tax assets and liabilities as per IS 12. So if your previous GAAP did not require this, you now need to recognize them in your opening IFRS statement of financial position. Similarly, you might need to recognize certain provisions like environmental provisions or decommissioning liabilities that you did not recognize before. Are we clear on that? Great. You recognize what IFRS says to recognize and you de-recognize what IFRS says not to recognize. Alright. Now the third key principle is that assets, liabilities and equity must be classified in accordance with IFRS. If the classification under your previous GAAP was different, you need to reclassify them. For example, under IFRS, compound financial instruments like convertible bonds need to be split into the liability component and the equity component. If your previous GAAP did not require this split, you need to do it now. Then the fourth principle is about measurement. Assets and liabilities must be measured in accordance with the IFRS. For example, maybe under your previous GAAP, you were allowed to discount deferred tax asset and deferred tax liabilities. But under IFRS, specifically under IS 12, discounting of deferred tax is not allowed. So you need to adjust the measurement also. And finally, my friends, here is a very important point. When you are making all these adjustments, recognizing new assets, de-recognizing old assets, reclassifying things, remeasuring things, where do all these adjustments go? They go directly to equity, specifically to retained earnings. They do not go through profit and loss. Why? Because these adjustments are not part of your current year performance. They are corrections or adjustments related to past period. So you adjust them directly in equity. For example, if you have to de-recognize a research asset of $100,000 in your opening IFRS statement of financial position, you would debit the retained earnings by $100,000 and credit the research asset by the same amount. The adjustment goes straight to retained earnings, not through profit and loss. Do we understand? Great. So all adjustments from adopting IFRS go directly to equity. Okay, now let me highlight something. My friends, the ISB knows that applying IFRS retrospectively can be very costly and time consuming. Imagine a company that has been operating for 50 years. Now going back and restating everything for 50 years would be insane. So IFRS 1 says, look, we want you to apply IFRS retrospectively, but we also don't want you to spend more money on this than the benefits it provides to users. That is why IFRS 1 provides exemption. Some are optional and some are mandatory exemptions. Optional exemptions are where you can choose whether or not to apply the retrospective adjustments, and mandatory exceptions are where you are prohibited from applying retrospective adjustments. Let's talk about these. My friends, IFRS 1 provides several optional exemptions. These are areas where applying IFRS retrospectively would be very costly or difficult. So IFRS 1 gives you a choice. You can elect to use any one or more of these exemptions. You don't have to use all of them and you don't have to use none of them. It's your choice. Pick and choose based on what makes sense for your company. Let me highlight some most of the important exemptions. Listen to me carefully, this is very popular exemption. Under normal circumstances, if you are applying IFRS retrospectively, you would need to go back and recalculate the cost of all your property, plant and equipment as if you had always been using the IFRS. Now, this can be a nightmare. So IFRS 1 gives you an exemption. It says that at the date of transition, you can use the fair value of your property, plant and equipment as the deemed cost. Here, deemed cost means that you are treating the fair value as if it were the original cost. From the date of transition onwards, you depreciate based on this fair value. This exemption is applicable, this exemption is available for property, plant and equipment, that is IS 16, for investment properties, that is IS 40, but if you are using the cost model, and for intangible assets, that is IS 38, if they meet certain criteria. Let's say ABC Limited has a building. Under previous GAAP, the building's carrying amount at 1st January 2024 is $500,000. Now, when ABC is preparing its opening IFRS statement of financial position, it gets the building valued and the fair value comes out to be $1 million. Now, ABC can choose to use this fair value of $1 million as the deemed cost, and going forward, ABC will depreciate the building based on $1 million value, not the $500,000. So for this adjustment, building would be debited by $500,000 and retained earning would be credited by $500. The building is now shown at $1 million and the increase goes to retained earnings. My friends, this is a very useful exemption because it saves you from going back and recalculating the historical cost. My friend, there is another very important exemption for business combinations. Under IFRS 3, there are very specific rules about how to account for business combinations. If you had to go back and restate all your past business combinations to comply with IFRS 3, it would be extremely costly and time consuming. So IFRS 1 says you don't have to restate business combinations that occurred before the date of transition. You can keep the same classification and accounting treatment you had under your previous GAAP. However, there are some adjustments you might need to make. For example, if goodwill exists, you take the carrying amount under the previous GAAP as the starting point and apply IFRS from then on. No amortization but annual impairment testing. Also, if there are any items that require fair value measurement under IFRS, you might need to remeasure them at the date of transition. But the bottom line is, you don't have to go back and fully restate all your past business combinations. So that's a big relief, right? My friends, another important optional exemption is for cumulative translation differences. Under IS 21, the effect of changes in foreign exchange rate when you have a foreign subsidiary, you need to keep track of cumulative translation differences in a separate component of equity called the translation reserve. Now, if you had to go back and calculate all these cumulative translation differences from the beginning of the time, it would be a nightmare. So IFRS 1 gives you an exemption. It says you can deem the cumulative translation differences to be zero at the date of transition. From the date of transition onwards, apply IS 21. This means you take a fresh start. All past translation gains or losses are deemed to be zero and you only track them going forward. This is a huge relief for companies with foreign operations. Also, under IS 23 borrowing cost, if you are constructing a qualifying asset, you need to capitalize the borrowing cost. Here, IFRS 1 says you only need to capitalize borrowing cost for assets where the commencement date for capitalization is on or after the date of transition. So you don't have to go back and figure out which borrowing cost should have been capitalized in the past. You start capitalizing from the date of transition onwards. Okay, now I have given you just a few examples of optional exemptions. There are more in the standard, but these are the most commonly used one. The key point to remember here is optional exemptions are there to save you time and money. You can choose to use them or not, depending on what makes sense for your company. My friends, let's now talk about mandatory exemptions. These are different from optional exemptions. With mandatory exemptions, IFRS 1 says you are prohibited from applying IFRS retrospectively in these areas. Why? Because the ISB believes that in these cases, retrospective application would require the use of hindsight, which would not give reliable information. Hindsight is basically the ability to understand a past event or situation only after it has happened. So the use of hindsight means applying the post-event understanding to evaluate past decision or to learn from them. So there are 8 mandatory exceptions in IFRS 1 and most of them are related to financial instrument. For example, you cannot go back and reclassify financial instruments based on hindsight. You have to classify them based on the facts and circumstances that existed at the time. So my friends, must remember that mandatory exceptions exist to prevent the use of hindsight in retrospective application. Are we clear on that? Great. Okay, now here is another important principle. IFRS 1 says that the estimates you make in your opening IFRS statement of financial position must be consistent with the estimates you made under the previous GAAP, unless there is a evidence that those estimates were wrong. Let me explain this with an example. Let's say, as at 31st December 2023, under your previous GAAP, you made an estimate for the provision of legal claims of $200,000. This estimate was based on your lawyer's advice at that time. Now, in 2024, you are adopting IFRS and your date of transition is 1st January 2024. When you are preparing your opening IFRS statement of financial position, you now know that the actual settlement of the legal claim was $250,000. Can you go back and change your estimate from $200,000 to $250,000 in your opening IFRS statement of financial position? The answer is no. IFRS 1 says your estimate must be consistent with what you estimated under previous GAAP, even if now you have more information. Why? Because if you are allowed to use hindsight and adjust all your estimates, it would not give a reliable picture. Estimates are estimates. They are based on the information available at the time. However, if there is evidence that your original estimate was wrong, not just different but actually wrong, then you can correct it. But in most cases, a difference between estimate and actual outcome is not evidence that the estimate was wrong. It is just how estimates work. The additional $50,000 would be recognized in the year it become known, that is 2024, as a change in estimate, not as an adjustment to the opening position. Do we understand the difference? Estimates remain as they were unless there is a evidence of error. My friends, listen to me carefully now. This is the one of the most important parts of IFRS 1. IFRS 1 says there are no exemption from disclosure requirements. Even though IFRS 1 gives you optional exemptions from recognition and measurement, it does not give you any exemptions from disclosure. You must explain to the users of your financial statement that how the transition to IFRS has affected your financial position, financial performance, and cash flows. And this can be achieved through reconciliations. So IFRS 1 requires the following reconciliations. First, you must provide a reconciliation of your equity under previous GAAP to your equity under the IFRS at the date of transition, and at the end of the latest period presented under the previous GAAP, which is typically the end of the comparative period. Let's say ABC Limited transition date of transition is 1st January 2024 and it's preparing its first IFRS financial statement for the year ended 31st December 2025 with comparatives for 2024. ABC must provide a reconciliation of equity from previous GAAP to IFRS as at 1st January 2024, that is the date of transition, and ABC Limited must provide a reconciliation of equity from the previous GAAP to the IFRS as at 31st December 2024, that is the end of the comparative period. This reconciliation shows users exactly what adjustments were made and how they affected the equity. Second, you must provide a reconciliation of total comprehensive income reported under previous GAAP to the total comprehensive income under IFRS for the comparative period. This shows users how the transition affected your profit and loss and the other comprehensive income. In these reconciliations, you need to show the title of the IFRS standard being applied, the nature of the change in accounting policy. If there were transitional provisions, you need to describe them. You need to show the amount of adjustments to the extent practicable. And if retrospective application was impracticable, explain why and how and from when the change was applied. My friends, ISB is very serious about these disclosures. Why? Because investors need to understand what has changed and why. They need to see the impact of moving to IFRS. And without these reconciliations, financial statements would be very confusing. Users would not know whether changes in numbers were due to business performance or just due to the change in accounting standards. Are we clear on that? No exemptions from disclosure. Okay, now, here is something interesting. When you are presenting your first IFRS financial statement, you need to present 3 statement of financial position, 3 balance sheets. Why 3? Let me explain. Number 1, opening statement of financial position as at the date of transition. In our example, it's 1st January 2024. Number 2, comparative year-end statement of financial position as at the end of the comparative period. In our example, it's 31st December 2024. And number 3, current year-end statement of financial position as at the end of the current period. And our example, it's 31st December 2025. This requirements comes from IFRS 18 and IS 8. Whenever there is a retrospective change in accounting policy, you need to present 3 statement of financial positions so user can see the impact. But remember, for the other statements like statement of profit and loss, cash flows, etc., you only present 2 statements, current year and the comparative year. Alright, my friends, before we wrap up, let me talk about some practical issues that companies face when adopting IFRS for the first time. Adopting IFRS is not just an accounting exercise. It has a wide-ranging implications for the entire business. Here are some things companies need to consider. First, your IT systems and accounting software might not be capable of handling complex recognition, measurement, disclosure requirement of IFRS. You might need to upgrade or change your systems. For example, IFRS 16 requires you to track lease liabilities, right to use asset, interest expense, depreciation, etc. So if your system cannot handle this, you are in trouble. Then second, many companies have loans from banks, and these loans often have covenants attached, conditions attached. These covenants are based on financial ratios like debt to equity ratio, interest coverage ratio, etc. So when you adopt IFRS, these ratios might change significantly. For example, under IFRS 16, all your operating leases come onto the balance sheet, which might increase your liabilities, and this could worsen your debt to equity ratio. So if your ratios breach the covenant limits, your loan could become immediately repayable. So companies need to talk to their banks in advance and renegotiate loan covenants before adopting IFRS. Then, many companies have bonus schemes based on profits. If adopting IFRS changes your profit figure, it could affect bonuses. For example, if IFRS results in lower profit than your previous GAAP, employees might get lower bonuses, and this could create unhappiness and conflicts. So companies need to redesign their bonus scheme to ensure they remain fair after transition to the IFRS. Also, adopting IFRS might change your profit, which will also change your earning per share, that is EPS. EPS is a key metric that investors look at. So if your EPS goes down after adopting IFRS, investors might panic and think your business performance has deteriorated, even though it's just a change in accounting standards. So companies need to communicate clearly with the investors to explain the impact. Then, adopting IFRS also requires knowledge and expertise. Your accounting staff need to be trained on IFRS requirements. Companies might need to spend money on training programs, or they might need to hire new staff who are already familiar with the IFRS. And this all costs money and takes time. So overall, adopting IFRS requires significant time and cost. You need to analyze all your accounting policies, identify differences between previous GAAP and IFRS, and then make necessary adjustments. You need to update your system, train your staff, and communicate with the stakeholders. It's a big project. That's why companies need to plan well in advance. My friends, let me clarify one thing. Pay attention. When an entity adopts IFRS for the first time, it applies IFRS 1, not IAS 8. IAS 8 is for entities that are already using IFRS and are adopting a new IFRS standard or changing an accounting policy. But for the first time adoption of IFRS as a whole, IFRS 1 applies. Once you have adopted IFRS, if a new IFRS standard is issued in the future, then you apply IAS 8, unless the new standard has its own transitional provisions. So for first time adoptions, we have IFRS 1, and for subsequent changes, we have IAS 8. Alright my friends, that's all for today. In a nutshell, IFRS 1 is all about making sure the transition to IFRS is smooth, transparent, and provides useful information to the investors and the stakeholders. I hope I have been able to explain all these concepts clearly in our today's discussion. IFRS 1 might seem complicated at first, but once you understand the principle, it all makes sense. We will conclude today's conversation here. Thank you for watching.